All right, all right. I see we got some folks in here. Can people hear me? This is my first time. This is my first time ever hosting one of these live streams. You know what I mean? I've always had the convenience of just coming in on other people's streams, and Jeff ran the Quampros. He did most of the hosting of the shows. I did more of the edits. We had a great, chemistry there. But any word in the chat, can people at least hear what I'm saying? I just want to make sure I'm not talking into the void here. That would be silly, right? Maybe I'll check the comp. We can hear. Dad Rabbit says we can hear. That's great. That is great. Let me just get my notes here. Alrighty. Let me orient the screen properly. See, there's so much there's so much nuance to learn here. You know what I mean? It's like I got to figure out like how the live chat works, how to orient the screens right. Keeping my notes on the side, but ladies and gentlemen, welcome to the first ever RyQuant broadcast. I chose this name because it has the Quant Bro in the middle as a shout out to the idea of collaborating on open source research at a very pivotal point in time. And because I want to call the show the broadcast. Like, ladies and gentlemen, welcome to the broadcast. Kind of own that word. It's like classy, but not over the top to where it's like off-putting. It's a good one. I want to try and own that word. But back then, early Quant Bros, the pivotal point in time was the creation of the Bitcoin spot ETF and what that meant for MicroStrategy's value proposition at a point in time when many were only considering MSTR to simply be an ETF in and of itself, right? Like they weren't fully grasping the levers that an operating company can pull. And by the way, one quick asterisk, I'm going to very interchangeably say MicroStrategy and strategy. It's so very much ingrained just into my like vocab and like into my thoughts. So please don't anyone take offense by that. I'm just going to kind of, roll with it, but you are going to hear some MicroStrategy references, as well as some of the artwork that I picked for this collage, whether it be the grand technological crusade that may purge ignorance from the planet. That was a quote on, I believe it was the Charlie Woods show interview of Saylor back in 2000. Love the quote, got the MicroStrategy title there. Love the Lambo strategy, like at the desk with a bunch of monitors going on. Love that. The MicroStrategy advantage of the top center image. And that goes back to what I was just saying about people, seriously misinterpreting MicroStrategy as just simply a Bitcoin ETF, just simply Bitcoin price exposure, when that simply was not the case. And now fast forward to today, and now the pivot point is MSTR as an operating company earning $10 billion in a single quarter, and what that means for a potential S&P 500 inclusion as strategy is on its path towards becoming the institutional grade operating company that is creating premium Bitcoin-backed fixed income securities. And we'll get into all that stuff later on in the show. Back then, in the beginning of the Quant Bros era, Punter Jeff, LOL. Punter Jeff asked the key question of how do we value any equity? The question that I would like to explore is, what is the purpose of a company? We will get to that later on and throughout these early episodes, but that's kind of what I want the grounding fundamental question to start the series to be is, what is the purpose of a company? And we'll get to that later. Folks can think of the show as kind of a cross between like Quant Bros, of course, and the Tim Dillon Show. Not nearly as like edgy or like some of the topics that Tim talks about. And I'll be more tilted towards the Quant Bros style, given the seriousness of the topics, but with maximum fun incorporated throughout. Consider something like the Peter Schiff show as a comparison. There is a limited amount of fun that one can have with Peter Schiff. He says the same thing on every show. I used to listen to it. It's always, a Great Depression is starting tomorrow at 8 o'clock in the morning. Or like him saying that the Fed is always doing the wrong thing, regardless of what the Fed's doing. It's always the wrong thing, or that tech stocks are always too expensive, which ironically, the inverse is actually true, right? Like if he thinks tech stocks are always too expensive and his like deep value stocks are always cheap, that part's actually true. His deep value like stocks are always cheap because they're all value traps that just decay value throughout the QE period. When Mag 7, or back then it was called FANG stocks, are ripping, Sailor's, writing a book to talk about, how like profound the impact of like mobile software is going to be on the world, placed a huge bet on it and all this stuff. And Peter Schiff was buying like British Tobacco Incorporated, or like British cigarette companies, or like gold miners who like do nothing but just sit on the gold in the ground, because the capital expenditures needed to actually get the gold out of the ground is more than the value of the gold in the ground. So those are bad businesses. But the irony there is that he's actually always right, that his stocks are always cheap. And that's kind of just what a value trap is. But the point here is that there's a limited amount of fun that one can have with Peter Schiff. And I know that's a low hurdle rate to set the bar, but I think folks get what I'm saying here. So what I'm going to want to look to do with the show is I'll go over my thesis on MSTR. No surprise there. I'll go over my investing philosophies. I'll talk about options theory from my perspective. I'll be talking about volatility and volatility as an asset class. I'll be talking about my cash book, which is a phrase that, folks have heard me say before, to the extent that people have listened to me before. But the cash book serves as, for me, for my purposes, like the thing that replaces the job, right? So to the extent that, folks are unemployed, that doesn't just magically make the expenses of everyday life go away. And there was a space on this earlier. I missed the person who was saying it, but they were saying, that like the 100% like Bitcoin allocation is tough, right? Because there's still all these ongoing expenses. And I won't, go into that too much, but that's kind of like the purpose of the cash book. And like I said, the people who have listened to me have heard me talk about that sometime. And I'll unpack like the theory and my perceived logic behind that and how I optimize that. Also, how I sell covered calls against MicroStrategy, against certain other things, and that interestingly enough comes back to the cash book too, right? Because the assets I own in the cash book, I'm also selling covered calls against them, against those assets, not just the growth assets such as MicroStrategy being the biggest one. So, kind of to put a bow on that point, if I had to summarize it into 2 words, like this show's really going to be about financial engineering and all of the creative, levers that can be pulled within that process. The other key point here, and this is something that I've, talked about ad nauseum, and there's a reason for it, is that nothing I ever say is like financial advice. You know what I mean? I used to be the goofball on True North. Like the guy who could like, be like, all right, we got like 10 people here. Like I'll like, be the comedian. That kind of brand. I have no Wall Street background. I have no business school background. I have no licenses or Series 7 or financial advisor titles. I'm just an independent research analyst who wants to like learn more and exchange. What I mean by that is I'm not trying to persuade anyone of anything, not at all. And that's even true in the posts that I make or like how I structure a sentence. I almost never use the word you or your, meaning like you should do this or you should do that. I never say that. I just say I, me, or my, or like this is what I'm doing, in the hopes that like a Ben Workman will come in and comment or text me on the side and be like, hey, I think you're a little off on this. You might want to refine that idea or something like that. You know what I mean? Where someone's going to correct what I have wrong or what I'm misinterpreting. And I really think that's the value of X, is that each individual is putting their work out there and assigning their name to it. So because of that public accountability feature, it doesn't allow people to be lazy, right? Because we know Twitter's a war zone. That's an Elon quote, by the way. That's an Elon quote. Twitter is a war zone. And there's something good about that, in that it's just such a battleground of ideas, and then only the best ideas end up making it to the surface. But getting back to the run of show and the agenda that we have here, just some more context about the show. I will look to have guests on from time to time. Absolutely. I will also take some questions at the end of each show, with the understanding again that I'm not going to give like personalized like financial advice or asset allocation percentages or anything like remotely adjacent to that. And the more thoughtful and like deep and like philosophical the question, the more likely I'll get to it. In fact, someone, I won't say who it was, but someone sent me a screenshot of like 5 questions already. So I'll try and get to some of those either today or on the next show, because there's really deep, thoughtful stuff there, and that'll actually be a great example of what I'm getting at here with like the thoughtful questions. One last kind of intro housekeeping things is that some folks may be wondering why this is taking so long. Well, it's one of those things, folks. You know what I mean? Like Elon, I run late on some of my predictions. I did overpromise and underdeliver a little bit a couple months back, saying like trying to get the podcast off the ground. And like my father always says, sometimes life gets in the way of life. And the timing was just not right for me at the time. But the timing is right for me right now, because I think we're dancing with destiny right here, right now, in this moment. So with that, let's go ahead and get into the show here, because we have a really big show. And I won't insult the great Ed Sullivan with trying to say his really big shoe in a serious way, but this is a real, tip of the cap to Ed Sullivan, an American icon in broadcast hosting. And I'm just going to play a few seconds of this. I'm not even sure if the audio is going to carry over or not. But man, this just takes me back to a better time before my time. Record breaking $50,000. Oh, the temptation. Oh, the temptations, earth, wind, and fire. I mean, doesn't this just take you back to a better time before the Vietnam War, before the President Jack Kennedy assassination, before going off the gold standard? That was just peak Americana right there. I mean, just the absolute top. And now's the fun part, right? All right, so moving right along. Topic number one. Big congrats to Mason on securing an epic Bitcoin job. As the director at Meloise in Brazil, forgive my pronunciation, I'm a, uncultured swine, but it really is awesome to see how quickly a life-changing outcome can be realized from, simply putting yourself out there on a podcast and then getting to work as an international man of business. But hey, please be careful out there with the ladies and the temptation out in Brazil. We don't need to, have all the fun of our lives in one night. And this thing is a marathon, but not a sprint. But please do enjoy the experience, sir. And I really am happy for you. All right. So moving right along. Topic number two. I have a bone to pick with Dan Hillary. By the way, you see how we can pivot from positive to negative? You see how we can pivot from praising to criticizing? I'm kidding here, by the way, with the Dan stuff, of course. I just think he is perhaps, overlooking the impact of this quarter's earnings and the implication that can potentially have for, an S&P 500 inclusion. Also, perhaps we're getting a little too fixated on the ATM, narrative as a whole. I would recommend the following exercise where we just, at a certain point in the deliberation, we just take a deep breath and then just start to let it go. But we'll talk more about that probably on another episode, a little bit in this one, but there's a lot to unpack there with the equity ATM. And I don't mean to, oversimplify with the whole let it go thing. Okay, so let's get into this because this is the thing that I really want to get into. And I think, framing that in the context of wanting to have a bone to pick with Dan Hillary is just a funny way to set that up. Okay, so in my opinion, strategy is the best business in the world. MicroStrategy has the largest Bitcoin hodl, and they're going after the world's largest total addressable markets. They are best positioned to disrupt those total addressable markets, even of companies that are outside the Bitcoin ecosystem. No other entity on earth is able to do what MSTR is doing at their scale. Not even Berkshire, because that's fundamentally the opposite setup, right? Berkshire is a massive buyer of treasuries, not an issuer of treasury type instruments. It's fundamentally the opposite setup. What would be interesting would be if like Berkshire would allocate some percentage of their, cash war chest towards Strategy's preferred offerings, or if an entity such as Tether was to allocate some of their war chest of US Treasury, T-bill type assets into, Strategy's preferred offerings. So again, instead of talking about the ATM FUD, which I know there's much more to unpack with that, I think what the narrative should be, and I think what we should be open-minded to, is MicroStrategy potentially raising $100 billion in the next 24 to 36 months and potentially doubling their Bitcoin stack, depending on a couple variables, most notably the price of Bitcoin. But I mean, if we think about the recent trajectory of the past, 8, 12, 10 months and the amount of Bitcoin that Strategy's been able to buy, to me, it's not outside of the realm of possibility that, $100 billion from now could be raised over the next 2 to 3 years. I mean, if we get 20 to 30 billion from the MSTR ATM, if we get, optimistically 20 or so billion from Stretch over the next, couple of years, if we, optimistically get 10 billion from each of Strike, Strife, and Stride over the next, handful of years, I think it's, within the realm of possibilities that 2 to 3 years from now, we've raised $100 billion and we're talking about having a Bitcoin hodl of 1.2 million Bitcoin. And, I just don't think that type of move is even being remotely discussed. It's just folks, honestly, just complaining about price action or, trying to position themselves as being smarter than the financial engineering team at Strategy, or just, getting too lost in the sauce with the common narratives. Whereas I think, 1.2 million Bitcoin within, 2 to 3 years is really the topic of conversation that we should be having. And next, one of the early moments that was discussed, or perhaps I'll say it was an early chapter of the Quant Bros thesis, was the reflexive flywheel effect of FASB fair value earnings and how that could create a potential pathway to the S&P 500 for Strategy, which could then, create a perpetual bid. And that's one thing about the, potential S&P 500 inclusion that's, one of the most bullish aspects of it for me, is that it's not just this like initial, okay, Strategy's not in the S&P 500 now, so we have to initially include them, and then like it stops there. Quite the opposite. That effect can keep going on an ongoing basis, assuming success in Strategy and in the price of Bitcoin. All of the quarterly rebalances can theoretically rebalance higher. Now, do I think all of the quarters are going to rebalance higher? No, of course not, especially because of the way that that the earnings are set up, with it being the quarter over quarter, earnings picture, or the formula for generating the FASB fair value earnings. It's quite likely that there's going to be, down quarters here and there. But there is this like ability for there to be like a perpetual bid in the index at, after the point of being included into any of the indexes. And this is where it ironically comes back to the equity ATM, right? Like all topics of conversation in MSTR ultimately come back to the Class A common ATM, and that, one of the hidden benefits of this is that it expands the market cap. Given the assumption that, price remains flat, if the shares outstanding goes up, the market cap goes up. So this is a way of, an additional lever that Strategy can pull in order to, indirectly or perhaps directly increasing their weighting in these, indexes, most notably the S&P 500. Whereas the Mag 7's doing the opposite, right? Like they're buying back their stock. They're shrinking the number of shares outstanding. And by the way, here's another thing. BitStrategy has been the only person, and I mean, I can go on and on and on about the theory value that BitStrategy's provided, but in this one instance, BitStrategy is the only person who's talked me out of the long-term thesis of Strategy buying back the stock like 10 years from now. And the reason is that, in most, like you look at Apple, you look at the Mag 7, how they do, share buybacks. When they buy the shares are retired from, the float from shares outstanding. So theoretically, it is shrinking, or let's say compressing the company. And BitStrategy's telling me this. And, I'd run the buyback idea past everyone, posted on, sorry. I'd posted about it on Twitter, you know what I mean? Had put it out there for the gauntlet of feedback, and nothing, moved me away from that position except what, BitStrategy had said. So, yeah, the point here is that it's an interesting lever, and it's interesting that it's a positive aspect of the equity ATM, that we can increase our potential weighting in the S&P 500 and the rest of the indices that we're still in, right? We're still in NASDAQ 100, the QQQ, still in All Country World Index. And this phenomena of being able to expand the company via the equity ATM is just a small hidden benefit of the broader operation. Last point on this is that Vanguard recently flipping Sailor and being the largest holder of the stock is honestly early evidence that this, beginning chapter of the Quant Pros thesis is true. The largest holders will be the passive indices, and I expect that spread to continue to increase between the passive indices and everyone else. The retail shareholder base, Sailor, everyone else who's directly involved in the shares. And I know it gets confusing, right? Because like my shares on my brokerage accounts are probably represented in, that the Vanguard, the Schwabs, the Fidelities, all that kind of stuff. So I know that gets wonky, but I think that the spread between the institutional passive index ownership is going to just continue to gain relative to everyone else, especially like at the employee level, because their shares are not, in the traditional brokerage accounts. But okay, so let me just pause there briefly and say that that's kind of my, MSTR, like big picture. Sorry, I got my nose is running a little bit. That's kind of my MSTR, like big picture, like thesis idea that I've been talking about for the past couple months. And in order to fully, wrap that around, the current picture, the current landscape, I think we have to compare it to everything else, right? One of my favorite professors at Rutgers was a history professor. He kept coming back to this idea of nothing exists in a vacuum, meaning like in the class, it was like none of the tribes or the nation state at this point in human history, none of the things that they did individually were just left there in a vacuum. Everything else still influenced everything else. So to that point, nothing exists in a vacuum. So how can strategy be the best business in the world if we don't at least compare it at a high level to everything else? So with that being said, let me get into the bear case for everything else, especially Tesla and Nvidia. And I'll get back to summarizing my thoughts on Elon in like a future episode. I think that stuff is like way less important than this, and it's almost just like a side like talk, like fun, like talking point to just switch to something like less serious on Twitter, as like most of the day is spent on like serious things. But with that being said, the bear case for everything else. All right, so number one, the margin picture across Mag 7 is not as rosy as I think many would expect it to be. Amazon, terrible margins. Either Amazon or Walmart is the highest revenue generating company on planet Earth, to the tune of something like $600 billion annual revenue. Both of those companies capture I think Walmart's net profit margin is 2%. So they capture almost none of it. I think Amazon, I don't know off the top of my head. And it's also, you got to blend the retail shipping of consumer goods business with the AWS business. And, the shipping of, consumer goods business is an awful business. It either breaks even or like loses a little bit of money. All of the value and the higher margins and the growth expectations are all embedded in, Amazon Web Services and that part of the business. So net between the two of them, I'm not sure what the margins are, but I would guess it's not higher than 6% net profit margins for Amazon, a multi-trillion-dollar, probably right around $2 trillion market cap. So Amazon, not that great. Apple, not that great net, I would say, in the sense that like the hardware business is, not the best. That's just one of the drawbacks of the hardware business. And I'm going to touch on that with like Nvidia and Tesla as well. It's just how the world works. The margins are lower in hardware than they are in software if we're using that as the comp back and forth. But then again, something like AirPods, if that was spun off as a standalone business, would be like a top 100 company in the S&P. Like it'd be in the S&P 100. But then again, no, it wouldn't, because it's benefiting from the fact that it's in the Apple universe and the connectivity of all the devices into the one ecosystem and universe. Steve Jobs was very big on this. So the hardware side's kind of a push. Where Apple really cleans up is the 30% tax that they have on all the, I shouldn't laugh at that. It's just kind of funny because it always comes up in the news as like it being like greedy or bad or like whatever. But where Apple really cleans up is their 30% fee that they have on all the developers who, push their software through iOS, the app store, the Apple App Store, I should say. So Apple is in a better position than Amazon, but it's still like not great net. So that's two of them. Microsoft's in a pretty decent position in the sense that like it's just all software. So back to the hardware versus software thing, I always think software is better. The margins are way better. The capex is way lower, inversely. You don't need that many employees. You don't need any, raw materials or manufacturing plants or steel or oil or any of this, like, real life, raw commodities and such like that. So yeah, so we're at Microsoft. So yeah, I definitely prefer the software businesses, but there's no like non-linearity in Microsoft, right? It's, it's the second or third biggest company in the world. There's no like aggressive like startup like growth trajectory. And by the way, there like shouldn't be. This is, a value company in its, stage of its life cycle. When Bill Gates was my age, Microsoft was a growth company, obviously, right? But now it's just not. So that's just part of what you get with a Microsoft type name, is that you're not going to have MSTR upside, but the hope is that you're also not going to have MSTR downside. So that's kind of the trade-off there. So perhaps maybe Microsoft is like a little bit above Apple or like a little bit below, but I think that's kind of like a net push. Let me do Google and like Meta, because they're kind of both one and the same to get to 5. These two are the exceptions of the Mag 7 bunch. These two are, the closest thing that we still have to founder-led companies. I guess you could still throw Amazon in that with Bezos being the chairman. And of course, Elon was like a day, like 3, employee at Tesla before they had any intellectual property or any other employees or any other anything. All they had was the name trademarked. But I think that both Google and Meta obviously with, Zuck still very much there full time. And I think Google also does still have some like founder type startup in them, with Larry Page and Sergey Brin still being very much engaged, especially in the past couple of years with their, push into AI and wanting to stay competitive in that nature. So I think both Meta and, Google benefit from the founder-led incentive structure piece. I also think, they have, excellent margins. Those two of the Mag 7 do have the best margins off the top of my head. And they have more compelling growth than like Microsoft as a comp. So those two are easy to get out of the way. I think those are the two exceptions to what I'm saying out of the 7. And then to bring this home with, Tesla and Nvidia, I mean, it's a tough situation. It's not a tough situation. It's complicated. It's nuanced, because I still think that Tesla and Nvidia are two of the best businesses in the world, right? Top 10, top 15, top 20. We can debate like where, but they're both very much still up there. But here's the hard thing, right? And some of what I'm going to say here extends to more than just Tesla and Nvidia, but here's the hard thing with these two. There is just so many issues and potential problems like all over the place, right? For starters, both companies are very dependent on regulatory developments and legal developments in China specifically, also in the US, but that's probably more well understood. But Tesla has a huge presence in Giga Shanghai, and that manufacturing hub as an exporter of cars to like Australia, Japan, mainland China, India, a couple other countries, probably like Russia as well, Korea, Thailand, Vietnam, right? Like that whole like Pacific area and like global east. That's where the cars come from, right? They come from Giga Shanghai, most of those countries that I just rattled off. So if perverse legislation or regulatory developments were to come out from China as it pertains to Tesla, like that has a material impact on the business. Same thing for Nvidia. And this has been like a recent topic of discussion. I mean, it's been going on for a couple of years now, but it's come back into the news in the past couple of weeks about, can Nvidia sell chips into China? Are they allowed? Are they not going to be allowed? And then on the other side, it's like, is China going to allow Nvidia chips to come in? Or are they going to look to build up their own infrastructure? So what I'm saying here is, the China thing is like very, very complicated. And that's part of just, the human condition of competition and how high the stakes are for global power and stuff like that. But that's a very, very complicated thing. And by the way, I didn't even get to all the other like points about Tesla and Nvidia. That's just the regulatory and legal issues, both out of the US, but also out of China, which is totally out of our control. And that's something that like strategy does not have to face, right? We also have the beneficial upside of having like the most bullish Bitcoin presidential administration that like many of us could ever fathom. If you would have told me 5, 6, 7 years ago that the sitting president of the United States would be like going to Bitcoin conferences and saying like never sell your Bitcoin, or even like acknowledging it in a serious capacity, I'd be surprised by that. I'd be surprised by Larry Fink really warming up to Bitcoin and launching the spot Bitcoin ETF. So we have all of that like positive regulatory net impact benefit versus Tesla and Nvidia that has a lot of question marks, again, just from the legal and regulatory perspective. And now we can go into all the other things, right? Like the sourcing of raw materials, right? Whether it be the cobalt, the lithium, the nickel, or all the components of the battery and how that pertains to, I think it was LFP, not something phosphate chemistry to put all these batteries together. And you got to have like all the contracts in place with all the countries so that you get all the raw materials at the right time. And Nvidia is doing this too with the silicon and the chips and, putting all the transistors into the chips. And I know even less about that process than the limited insight I have into Tesla, but they're still doing the same process, right? Like having to source these like high value raw materials. And here's the other thing, it all has to be done in the right time. one of the broader trends about like globalization and the way of, you know, global capitalism is that everything's like just in time delivery, right? Which is why something like COVID is such a massive shock to the system, when all of these parts of all of this interconnected global supply chain have to happen at certain points so that the next part of the process can happen. Just throws the biggest monkey wrench into the system. Whereas, you know, theoretically, a COVID type shock, like Strategy's business, like continues like performing fine to the extent that capital markets perform without, you know, a devastating crash or something to that effect. If a global pandemic happens, like Strategy, like we can keep selling like preferred, you know, securities. Why not? Like nothing stops that operation. So that there's almost something, not there's almost something, there is something very anti-fragile about this digital only operating environment that Strategy happens to be in. What else is there? There's no like, you know, manufacturing or complexity with you know, Strategy's operation. Whereas, you know, with Tesla and Nvidia, they have to hire a ton of employees. They have to have all of these really robust and refined and well optimized, you know, manufacturing processes that involve like robot arms that like go up like this, and it picks up the base of like a Model S and then like swings it over here and puts it onto another conveyor belt so that the doors can be put onto it. I mean, there's just literally so many moving pieces with that, like how hard manufacturing is. And this is one of the things that I think Elon's like, you know, 1,000,000% right on, is just how hard it is to manufacture things. And that's just been one of the takeaways that I've had for studying Tesla for 6-7 years now. I think he's 100% right on that. Ditto for Nvidia. You know what I mean? They have like highly trained scientists wearing, you know, foot to head, you know, the white like smocks, almost like they look like the people during COVID, like treating the people with like all the gear on head to toe, totally like sterilized environment. And they're doing these things with these massive like machines that are, you know, bigger than the size of the room that I'm in. I mean, it's just all very complex, sophisticated, nuanced things. Like so much so that, you know, months after I had sold my Tesla position in, you know, August of last year in 2024, you know, a number of months went by and it hit me like, I had no idea, like I had, and I will not have any idea as to what's really going on at Tesla and the potential challenges and how to quantify these risks and the complexity of it all, versus something like Strategy, where I think it's very much possible for one person to have a very thorough, solid, comprehensive understanding of both the company and the investment opportunity. And if one individual can't do it, what I think is even has a higher probability of working is something like Quant Bros or something like True North or something like, you know, finding a few like-minded friends and just talking with them, sharing the ideas, bouncing them back and forth, reading Ben Workman's posts, reading Dan Hillary's posts and Punter Jeff's posts, and really like thinking through like what they're saying throughout that process. It's not going to happen overnight. And by the way, nothing happens overnight. Nothing like relevant of noteworthy happens overnight, but over the weeks, months, couple years, like it's totally within the realm of possibility for one person or a small group of 2, 3, 4, 5 people to have a solid A or A plus level understanding of MicroStrategy. I believe that in absolute terms, and I definitely believe it in relative terms when you compare to Tesla and Nvidia. I mean, there's just so much going on. It's so impossible to, from my perspective, impossible to measure and quantify those risks, and you know, just have any like strong, thorough understanding of the status of the business at any point in time. Whereas every time strategy does a new Bitcoin buy, I update that table that I posted today. Let me just bring this up since we're talking about it. But where is it? This thing here, right? Let me bring a picture. Every time strategy announces a new buy, this table ends up getting automated on the strategy website, and then you just, you know, copy paste it, you know, isolate the new column you need, paste it onto this. And again, this is just one of those examples of real time, in the moment. I feel like I can like accurately quantify, gauge, measure the success or performance or potential failure of, you know, strategy in real time. Considering everything I said about like Tesla and Nvidia and the operational complexities from start to finish of that business, I just can't imagine anyone making the case that they can also do that for Nvidia or Tesla. And again, I don't mean to beat up too harsh on any of those companies or really pick on them. I do think they're wonderful companies. I do think that many of the world's smartest people are working for those companies. So I wish them well. You know, I mean, it's like it's like the Donald Trump like dismissal line where he's like, you know, Ghislaine Maxwell, I wish her well. Like he's like on the golf course about to like tee off, and he's like, I wish her well, and it's like a dismissal. It's like, look, I wish Tesla and Nvidia well, but you know, I'm just not going to take the journey with them. Last point on that before I wrap to my or push towards my final topic before a Q&A session is that there is a ton of competition all over the place for Mag 7 related companies. I mean, literally all of them. There's hungry and aggressive startups coming for all of them, right? Or medium to large scale businesses that are already public, that are well capitalized, well resourced, and are also coming after them. I mean, I can go down the list of examples where, you know, AMD and Supermicro chip SMCI are going after Nvidia. Waymo and the robot companies. Who's that one guy on Twitter? He's the founder of a pure play. It's a private company, but it's a pure play robot company. So Tesla has competition in both the cars, the self-driving cars, and the robots. Who else? Apple's always going to have the Samsung and like Android competition, as well as, you know, facing pushback from Fortnite. Remember that? Remember the legal battle between Apple and Fortnite over that 30% thing that I was talking about earlier? Who else? Amazon has competition through what's the Jack Ma, Alibaba in China, and I believe also Mercado Libre, if I'm not mistaken, is the Latin American version of Amazon. There's also there's one in Africa too. This thing was one of the high flying tech stocks after COVID. I forget that one, but there's definitely a global dynamic Amazon type competition in addition to the obvious, you know, there's Walmart, there's Target for all the consumer goods. And then on the cloud side, there's also, you know, Microsoft, Azure, Google Cloud. I think like one other big one of note. So Amazon's got competition all over the place. Microsoft, like I said, they're competing with Amazon, with AWS. They're also competing with every software company on earth. So much so that what Microsoft looks to do is either like acquire companies, or if they won't like play ball with Microsoft, then Microsoft will just reverse engineer whatever SaaS product this company is making and then bake it into their, ecosystem, like universe of products for free, for nothing, to just crush the margins of the company that won't play ball with them. And by the way, there's a funny scene on this in The Simpsons, of all places, where like Bill Gates is like buying Homer Simpson's company, and he's got like bodyguard type guys with him, and Bill Gates is like, buy him out, boys, and Bill just like destroys the company to just like crush the competition. So Microsoft, it's well documented that Microsoft is quite well aware of the competition. And who else? I mean, Google's got perpetual competition in the form of ChatGPT and the other, search engines that have come up over time. Facebook, Meta has perpetual competition with Snapchat, with TikTok, with this app, that app, WhatsApp, but that's actually theirs. Did I leave any out? I think that's all of them. Yeah, I think that's all of them. Netflix, even throw like Netflix in there. Netflix has competition with Amazon Prime Video and all the other, Hulu, like I said, all the other apps. Like all of these companies are just all perpetually competing with each other. Whereas I feel like MicroStrategy is not actually competing with the other Bitcoin treasury companies. If we think about it mechanistically, like these companies are really all benefiting each other, in the sense that like they're quasi essentially all doing buybacks for each other on the main primary asset that all of them own. And that's like the real take there about the virtuous cooperation like narrative, is that mechanistically it like very much aligns all the interests. So I don't think there's competition in that like higher level, perhaps like abstract sense. But then again, it's not abstract, because there is like the mechanistic actual buying of the asset that like pumps everyone's bags, for lack of a better term. So yeah, I don't think there's competition in that sense, and I also don't think that there's competition in terms of like moat. I think this is a one-way irreversible ticket. I think the writing's been on the wall for months, if not maybe a year or longer by now, that no entity on earth is going to be able to overtake Strategy as the world's leading holder of Bitcoin. And because of that, I think that Strategy does deserve to trade at the highest MNAV premium of them all, because they justifiably deserve to have the highest creditworthiness of the bunch, thus making them the optimal issuer of these preferred fixed income securities, which are going after the world's largest total addressable markets. I know that was a run-on sentence, and it's very much connecting idea number one with idea number two, with 3, 4, 5, but that's the fullness of the narrative, especially as it pertains to this idea of competition. Okay, and here's my my last topic, then we'll do some questions. Here is a high level thought experiment for like the entirety of the Bitcoin treasury company industry, in that many folks who cover the non MSTR, like all the other ones other than MSTR, they're baking in an interesting thought into their concept. They're baking in an interesting idea into their posts and their podcasts and such. And the idea is something roughly of the following, in that if MSTR is successful at selling and scaling the preferred offerings, then this other Bitcoin treasury company will too. And on the surface, like that's a good idea. I guess there's nothing wrong with it inherently, but the problem is when you know start to like really unpack this in like higher order thinking, is that the problem where this logic breaks down is that if we are granting the optimistic assumption that MSTR's preferred offerings are successful in terms of size and scale, for the companies situated in the largest capital markets on earth, with being the public company that has the longest track record in this space, which means a lot to a lot of like traditional finance folks, with the world's most recognizable Bitcoin bull as the founder and chairman, and all of the incentives that come with that in both the founder piece and the executive chairman piece, which to me suggests like you put all those ingredients into the cake, and this suggests a winner take most environment in which MSTR disproportionately benefits. And if you think about it, this dynamic occurs like throughout different industries of life, so to speak. In movies in Hollywood, we could say, Tom Cruise makes all of the money, or insert your favorite actor makes all of the money. In music, Taylor Swift makes all of the money. In podcasting, Joe Rogan makes all of the money. Perhaps strategy ends up making all of the money when it comes to the ability to launch a perpetual preferred fixed income security that is a better product than what's out there in the world's two largest total addressable markets, including sovereign debt, T-bills, bonds, money market accounts, mortgage-backed securities, checking deposit accounts. My mother was in checking deposit accounts. I recently got her set up in a brokerage account, with Strike and Strife, and going to be adding Stretch to that here soon. But all of these fixed income type things, I bonds, the government will sell you $10,000 worth of I bonds every year. All of these fixed income type, banking 4%, 5% things on the fixed income side, I think Strike, Strife, Stride, Stretch, some combination of that is better than all of those things on the fixed income side. Similarly, on the real estate side, when you think of any, when you think of the expectations with any like real estate rental property, where there's the expectation that like, okay, we'll get tenants in the place, they'll pay us this month, they'll pay us this much money every month, and that's this much above the mortgage costs. So every month we can expect like this much, yield or, cash flow or dividend per se. What I'm suggesting is that, a real estate rental, arrangement of sorts is really just a fixed income vehicle or instrument. But it's kind of even worse than like the bonds and the money market funds and all of that stuff, because on the real estate, rental side, you have all of the physical domain risk. And boy, has there been a lot recently with like the fires in California. There was a flood in New Mexico very recently. There was a flood in New Jersey very recently, in addition to winds, storms, fires, mudslides, all these other things that don't make the news. There's a ton of downside in the physical domain risk. And boy, isn't that one of the takeaways of studying like Bitcoin strategy, things of that nature. It's like, wow, it's really nice to like, minimize the physical domain risk versus owning something like, Tesla, Nvidia, or all of the other Mag 7 companies, which I just ragged on. Again, I think those are all wonderful companies. We have to compare things because nothing exists in a vacuum. So, okay, that brings me to the end of my monologue. I thank everyone who sat through and just bared through that. Also, thank everyone for the lovely, kind comments that have been flowing through Twitter, flowing through the messages. The things that folks have been saying recently is like nothing short of like heartwarming and optimistic, and it really does mean something. So I just want to say that. And with that, I'll open this up for a few questions. If we need questions, like I said, I have some in my messages already. And if we have no questions too, that's also fine because it's midnight and I'm exhausted. But because I said we'll do this, let's do a few. Thank you everyone for participating in the chat here. Okay, Atlas. Now, how do I show this? See, I'm learning something new. That's my first time ever sharing something on screen. Look, the thing with Checkmate, I went about that the wrong way, and took a couple of days off of Twitter after Friday because I was just so like not proud of myself for how I handled that. There's truly no reason to be hostile with these sorts of things. I think the diplomatic and statesman approach is really the way to go. Not so much that I care necessarily about what others think of me, but I care about what I think of me, and really just not happy with myself with how I did that or how I did previous things, such as like last year, which is being unnecessarily like, hostile, aggressive, whatever words you want to use. It's just it's not the move. I might touch on the thing that I'll just do it now real quick. Checkmate again. I went about this like the complete like wrong way. So like that's on me. I'll do better to be better in the future, but there's just been a number of like years now, literally, where it's been like it's just these perpetual bad arguments. I even pulled some of the links. I was going to show them, but then I was like, no, let's take this out of the show. So it's like, who cares? But like whether it's stuff like people being like, oh, the next unwinding is Sailor, meaning that like, MicroStrategy is going to be margin called, or MicroStrategy is obsolete because if because like the Bitcoin ETFs are out now, or the really bad comparisons of like, MSTR to Luna, or, the Grayscale Bitcoin Trust, or even FTX, or, people just saying like, strategy's a Ponzi scheme. I mean, it's just been nonstop, or the worst one every day, every late night space I did last year on MicroStrategy, without fail, someone would come up and ask a question of, well, what's going to happen when the government like definitely 6102s like MicroStrategy? And it's so crazy how the 6102 folks, I've never heard a more confident group of people in my life, by the way. Never heard a more confident group of people in my life. Like, to them, it's like an outright certainty that at some point the government is going to 6102 strategy. And strategy, the well-resourced, well-capitalized, staffed from a human capital perspective, got a couple lawyers, you know what I mean, are just going to roll over and just allow this potentially bad outcome to happen in the most negative way possible to the shareholders is just a remarkable feat of confidence. To feel that confident about something as complex and nuanced and situationally dependent and with so many moving pieces and so many moving variables is just like really interesting. But again, that would come up like every day last year. So again, the point I'm trying to make here is that there's been just like an onslaught of these rather unsophisticated takes that are just presented and laid out there as objective fact. And most of the time I can just like let these things go, but I guess I have my own like boom bust cycle. It's like a U shape, like the VIX, where like most of the time I can let it go, but then like I like snap. Most of the time I can let it go, but then so I'm going to try and reduce the volatility there and just, just let it go, or just be a diplomatic statesman or something like that. And then as it pertains to the checkmatey thing, there was an article that he shared that kind of compares and contrasts the raging bull market of the 1920s and some of the investment trusts that were involved in the marketplace at that point in time with the rise of Bitcoin treasury companies. And there was words of it's like the signs are there, you're ignorant if you don't see it, or something like that. So between the roaring 20s comparison and the notion of like the you thing, like remember what I said back at the top of the show, like with the not financial advice, I actually like bake that into my sentences by never using the word you. So between these things, it bothered me. I went up on the VIX spike of the personal VIX spike of reacting to these things. And one of the things that, or two of the things that like really have to be top of mind in this situation is like the relative size of like the market caps of these types of instruments, investment opportunities versus those types of things that were invested in the 1920s. And I don't have those numbers off the top of my head, but when you divide them by GDP of the times, in terms to just get like a relative gauge of like in the moment, like what is the market cap divided by GDP of the time to see how much influence could this even have? The influence is way lower on the Bitcoin treasury side. So again, don't have the numbers on me right now, but like it's very safe to say that the potential net negative impact of Bitcoin treasury companies is way smaller in my personal view than what the investment trusts of the time were for people in a much more broad like investing sense. Something like early indexing would be the best way I would describe it, versus something like Bitcoin and MicroStrategy, which is really like an echo chamber of like a relatively small number of like core believers. It's still like, this is the whole like we're still early thing, is that like it really is this echo chamber. It's not like a much broader, all types of investors are interested in this thing in the way that dynamic was very much true in the roaring 20s. So that's like the first piece of context. The second piece of context, which I think I actually do have right here, I might as well just throw this on screen since we're talking about it. This right here, I'll try and like zoom in on this. Let me make sure we're sharing the right thing. Okay, so I found this article, IMF e-library. Is that the International Monetary Fund? I don't know. Who doesn't love the IMF, right? Let's not go there. Let's move on. Okay, did universal banks play a significant role in the U.S. economy's boom and bust cycle of 1921 to 1933? A preliminary assessment. The key thing here is these two paragraphs that I'm going to touch on. Commercial banking organizations were leading participants in the U.S. securities markets during the great bull market of the 1920s. Commercial banks again entered the securities market during the 1990s, which, side note, I didn't know that. I found this article today, but I was familiar with the Roaring Twenties commercial banking phenomena. Hence, I knew to look for the article. But I learned today that they were also involved in the 1990s. Back to the reading. Back to the sacred text. And their re-entry coincided with another spectacular rise in the stock market. The stock market booms of the 20s and 90s were extraordinary events in U.S. economic history. As two scholars recently observed, the bull markets of the 20s and the 90s stand out, both in their terms of length and rate of advance in the market index. These two booms were unique in character as well as magnitude. By the way, that's all true. This talks about the crash, but that's not exactly necessary. Here's the part where it gets interesting. In both the 20s and 90s, commercial banking organizations were allowed to operate as universal banks. That is, diversified financial conglomerates that offered banking, securities, and insurance services. It is merely a coincidence that the two most dramatic stock market booms and crashes in U.S. history occurred during periods when large commercial banks were major participants in the securities market, ? Or did the exercise of universal banking powers contribute to the financial and economic conditions that produced both episodes? This chapter is the first installment of a longer-term project that seeks to answer these questions. Okay, back to my thoughts here. So to simplify that kind of like academic written paragraph, what the banks were doing at the time was taking consumer deposits and investing that into equities, like investing that into S&P 500 names. And some were even taking like margin or leveraged positions with the consumer deposits into, S&P 500 equities, or like these like investment trusts that we were talking about just a few minutes ago. And that's not happening now. And I would say that this second point here is like much, much, much more important than even the first point I made about like the market cap of all the Bitcoin treasury companies relative to American GDP compared to, the investment trust market cap, so to speak, divided by GDP at the time. And the reason, I mean, that's just the thing with the banks, like investing, people's consumer deposits into equities and investment trusts. Like, that's just such a massive, like that's like all of the people's like money, like, bidding equities and risk assets higher. And I'm saying all of this to say that like, that's not happening now. And without like these like key differences like being established, then history serves as no guide as far as I'm concerned. And by the way, here's the other thing. This whole notion of like, like people hate the phrase that like this time is different. The TradFi boomers and the Warren Buffett disciples, they hate hearing how this time is different. But it's like, here's the reality. Here's the honest like truth of the matter, is that every single time is different than the last, especially when you're talking about having a century of time in between these two events, because then it brings into the discussion like what's driving the economy in the 20s versus in the the 1920s versus in 2025. Well, in the 1920s, it's, you know, textile mills, it's the Industrial Revolution, it's Henry Ford making the Model T. It's very, you know, blue collar. It's almost a different world. Like, we almost could not imagine like living in that world versus today. What drives the economy in the world? It's like, it's the internet, it's digital payments, it's being able to sell things like to any person all over the world. It's being able to be a solo entrepreneur and be a founder and start your own company and have a one-person company. Like, it's being able to use tools like AI. Like, think about that difference in a vacuum. Like, our current like access to information versus the access to information in the 20s. So again, all of these major paradigm shifting differences just brings me back to my like original like thought of like every time it's different. And if we never address like these types of differences, then we're just not making any progress, and history serves as no guide. So yeah, and look, again, I approached the whole checkmatey thing like in you know, it wasn't good. That's how you take something down. It wasn't good the way I handled that. There's no reason to be hostile. So yeah, that's really all I got to say about that. I saw Ivar. Ivar's looking for a hot take on Stride. Not much talk about Stride. What's the sitch there? Great question. I would say that the sitch there is that I understand it the least out of all four, including Stretch. I also think there's a couple more like wrinkles in the cumulative versus non-cumulative. We cannot pay you here. We can pay you here. We can do this or that. It's honestly just a bit more complicated for me to wrap my head around. The thing that I do think I understand about it is that this is like the high yield junk bond part of the yield curve that Strategy is building, right? Like, if we think about that broader framework of what Strategy is doing with the preferred fixed income securities, is that like they're replicating their own Bitcoin backed securities yield curve. And I should have had that slide ready to go, ready to share the one of Saylor's tweet where he mentions we're building out the yield curve. Or it might have been in that video he did with Long Fong where he mentions it, and I did a caption of it. But even with all that being said, I do own a little bit of Stride myself here as part of the cash book, even though I don't understand it relative to the other ones. And the other thing is that I just like Strife better than Stride, if I'm being honest, with its preference in the capital stack. And again, it's easier to understand. But however, I do own a little bit of Stride. It's my smallest allocation between the four of them. I own some of all of them as of now, with Stretch being tradable. And the other good thing about Stride here too is that like it's so under par. I mean, off the top of my head, it's like, you know, $85 or something like that. So the effective yield now is like, you know, roughly 11 or 12%. So you get a little bonus like cherry on top. But yeah, all things considered, that's my thoughts on Stride. I think it's more complicated, a bit harder to understand. There's a few more moving pieces, but it is, you know, to my understanding, the high yield junk bond portion of the Strategy yield curve there. So let me see if we got any more questions. I'm going to do one more, and I think I'm going to end up pulling this from my messages. I got some really solid messages. Someone, again, I don't want to, you know, dox them or anything, but they made an Apple like note of the questions, and I want to get to all of these at some point. I hope the person's listening or will listen to this in the future. Number one on your list, how are you using the preferred stocks in your cash account, and how do you plan to include Strike in that mix? I talked about most of that stuff, but how do I plan to include stretch in that mix. Sorry if I said strike just now. I meant to say stretch, STRC in that mix. I love stretch. Love stretch, especially if my understanding of it is right in that this could potentially have even less volatility than strike and strife, which in the grand scheme of things, for people who deal in like, you know, high beta tech stocks or like volatility derivatives or like MSTR options or even MSTR stock itself, strike and strife's volatility is like, it might as well be zero for me. I'm just used to things that move around so much more. So strike and strife only moving 2 or 3% a day at like their upper limits is like, might as well be zero for me. But stretch potentially being like, you know, noticeably less than that is very compelling. The other thing, and time will tell with that. I'm not sure. That's all speculation. The other thing that's great is that stretch had the highest IPO out of all of them, just in terms of like dollar size. And that's another chart that I should have had ready to go, is the strategy page posted this recently, where it's like the strike, strife, stride, stretch, all the preferreds in order that they came out, and the subsequent dollar amounts at their IPO date. And, you know, strike is like 500 million and stretch is like 2.5 billion. And then like, you know, strife is a little bit more than strike and stride's a little bit more than strife. So it's this like nice, like up and to the right. Like it's one of those like, look at the chart type moments for people who remember that inside joke. But it's really compelling and reassuring to see that stretch had the highest IPO out of all four of the preferreds. And it's just great to see like the slope of the curve of all four of them, like literally building a ramp, as like we talk about the ramping of the preferred securities. So it's just really neat, really compelling and interesting to see that play out. So that was number one. Number two, speculate on the reaction to earnings, as well as the RyQuant Kingmaker trade involving the August 1st 500 strikes. This is such a tough one, and folks who know me know I almost never dabble in buying short dated options. I will regularly, you know, sell covered calls or sell cash secured puts tactically and opportunistically. But as far as buying short dated options, puts sometimes, but buying near dated calls, I should say, to get the terminology right, I almost never do it, because the near dated call option market is synonymous with a graveyard. There are many broken dreams in the near dated you know, call option market. And this is where, you know, you get the Warren Buffett type response and philosophy of derivatives are, you know, weapons of they're weapons of mass destruction. Derivatives are weapons of mass destruction. And so yeah, I have no interest in doing this normally, to the extent that I ever want to get long call exposure to something like MSTR or like Tesla back in the day. It was always in like the longest dated options, you know, stuff that was at least 18 months, at least 12 months, but more in like the 18 to 24 month range. And also, one last quick point on this. I once heard punter Jeff quote Jeff Park. So there's kind of a Jeff derivative double whammy here. I once heard punter Jeff quote Jeff Park in saying that near dated options are for selling, long dated options are for buying. And I just very much ascribe to that school of thought. And I said all of that to say I normally never look at the short dated call option market for MSTR or for anything because of all those reasons I just laid out. However, comma, two things can be true at the same time. However, comma, this setup is just, you know, it's one of those things for me where it's like, if you're gonna play the game, these are the things that at least have to be explored. And by the way, oddly enough, I got burned on this setup already last year at MicroStrategy World in 2024. We were sitting there, me, a couple guys, Grain of Salt, a few other of the usual suspects. And, you know, most of us are, you know, have some like a very small, like gambling sized allocation to the 3,800 call strike. This is before the stock had split. The deepest out of the money, you know, front dated contract. You know, we only had them for 2 or 3 days, or, you know, a very short period of time, but we're sitting there, MicroStrategy World 2024, Monday's the day of earnings, which, for the context, that's the day that we thought MicroStrategy at the time was going to voluntarily make the switch to FASB fair value earnings, which at the time would have come out to, I forget the number, but it was something like, you know, it was something oddly in the ballpark of like where we're at today with, you know, earnings this week being, you know, in the $35 earnings per share. Like it was a setup like this on the screen where like the analysts, like the lovely industry analysts, have a consensus that's just like definitely wrong, to the extent that like MicroStrategy at the time chooses to switch to FASB fair value accounting. So I was sitting there at that table listening to the MicroStrategy earnings call, and I had like $12,000 worth of these like front dated, you know, $3,800 strike calls, and I think the stock was at like 1,000, like 1,200. Like it was such a pie in the sky. Like, all things considered, I should not have went like that deep out of the money, all that stuff. But like, I was wrong. Like, we were wrong, the people sitting at the table, in terms of like, is MicroStrategy going to pick this Q1 of 2024 period as the time to switch to FASB fair value accounting? So that $12,000 worth of puts, you know, the next morning we go to breakfast. It's that same crew like sitting down at the breakfast table, and it's like kind of a somber breakfast, right? Because whatever exposure we had on that like gambling position was unsellable the next day, meaning, you know, you're eating the 100% loss there. But it was all good. We ended up bouncing back and like having a great time at the conference, and like forgot about it right away. But the point here is to say, like, I've already been burned on like this same setup that we thought was going to happen in Q1 at MicroStrategy World on that Monday of last year. The difference now is that like we have a 99.999%, you know, degree of confidence that 10 to 12 billion dollars worth of net income is going to the bottom line, resulting in, you know, about $35 of, you know, earnings per share, which again, if we look back at our lovely industry analysts, you know, on this view from Schwab, has the industry analyst projecting, you know, -9 cents earnings per share, and it's probably going to come out as be something as $35. So again, if you're going to play the game, these are the things for me and me only that I want to you know, really think about. So tomorrow, pretty early, I am going to be you know, looking for the news for the, you know, the White House, the federal government's like release of some type of information regarding their holdings of crypto, or maybe it's just Bitcoin. It's probably all of them. So I'm gonna be looking for that, and looking to perhaps express some type of view in the financial markets, either right before or right after that. But to the extent that I do this, and again, this is just me saying like what I'm like thinking about doing is I'm not going to do August 1st. I think that takes me back to the same, well, not quite, because the last year at MicroStrategy World 24, the earnings were on a Monday, and I bought that Friday, like of that same week. Monday's the first day, earnings day. Friday's when the contract expired. So I did still have like a week of time on that, but I'm not going to do August 1st, where there's only 24 hours of time from the earnings announcement to when the contract expires. And of course, obviously, the theta's at the most extreme level intensity possible when there's only 1 day left on the contract. So I'd be looking at, August 8th, August 15th, probably August 8th, to be honest. That's probably the optimal sweet spot at the 500s. But again, this is just a hypothetical thing that I'm kind of like thinking about out loud. I like that 500 level. I like the 500 level for as it pertains to like, getting to a realistic like 560, 570, 580 in the MSTR underlying versus, what I did last year, MicroStrategy World 24. I was just idiotically like deep out of the money. Which is fine because it was such a small like dollar amount, and it's also good to learn that hard lesson. But yeah, thinking like August 8th. Yeah, at that 500 level. All right, so that's question number 2. Question number 3, thoughts on owning strike or stretch in a margin account. Margin and leverage are things that I feel like I really have no business talking about in a public sense. These are questions. These are, of course, discussions that I have with friends and colleagues all the time in like an offline sense. But I would feel irresponsible even talking about margin and leverage in such a public capacity. Are there interesting and creative, and is there a ton of value creation that can come from margin and leverage? Oh yeah, there definitely is. And that was how 2023 and 2024 was able to be the life-changing outcome that it was for me. However, the bad thing is that like there's real like risk of ruin with like margin and leverage, and in the same exact way that returns can be magnified to the upside, they also get magnified to the downside, and it feels like something that's like melting to zero when it happens to the downside. And I think the old heuristic is so true and spot on, that men feel the joy less intensely than the pain. And I think that's so true. And this is one of the many reasons why active long volatility, like VIX exposure type trading, is such a powerful one, because these intense sell-offs in the markets, like think, COVID or the yen carry trade or tariffs, the sell-offs are so severe, meaning like stocks take the elevators up. Stocks take the stairs up, but the elevators down. These sell-off moves are so intense, and I think a lot of that is because of the human condition of people feeling the joy less intensely than the pain, than the fear, than the uncertainty, than the chaos, than all of these things. So there's a real business in active long volatility trading to like capture value from that human condition function. But Yeah, so like again, I just wouldn't feel comfortable like doing this, especially because like here's the other thing, like everyone's living situation is totally different. Meaning like me at 30 years old, I'm 32 now, but me at like 29, 30, when I really started like plowing into MicroStrategy in both the equity and the options and the leverage to buy more options. um you know I was in a like situation of like 30 years old, no kids, not much like responsibility that I'm like directly accountable for. And like, if Bitcoin and MicroStrategy would have like went to zero or some like devastating outcome, it's like I'll just go get a job. You know what I mean? I was fortunate enough to leave corporate America, at that 29, 30, 29 years old, 30 years old, like point in my life. And it's like, all right, well, like if this like really blows up, I'll just go get a job. And it's like, that's normally what 30-year-olds have done for, the long tail of human history. It's not like, my kids are going to not eat, or the family member that I'm a caretaker of is not going to be able to receive care or the financial benefits that I'm providing to them because I just, lost all my money in the options market. You know what I mean? So everyone's like life circumstances are just so fundamentally different that like talking about something that has like the downside real life impact risks such as like margin and leverage, like I really don't even want to get into it. And like that's got to be something that's like a full-time job too. Like that's the other thing, like people are so busy, and rightfully so, with jobs and wanting to progress in their jobs and have families, or go on dates or have a social life. Like people want to do like all these sorts of things that like you start talking about like leverage or like trading options or like this other stuff. Like it's got to be a professional in a full-time like capacity, or else like it just doesn't make any practical sense whatsoever. So that's enough on number 3 out of 5, and then we're gonna wrap on the end of this. Number 4, the possibility of borrowing against MSTR shares in the future, strategies to consider. Unfortunately, number 4 goes right into everything I just said about number 3. To at least touch on this at a high level, like this is that financial engineering post I did a while back with like if someone has like the skill set of understanding like statistics, Excel math, financial engineering, equity, leverage, debt, um, dividend, cash flows, like all these sorts of things, like it opens up the possibility of like, buying a house in such a way that there's like no like you almost don't even like pay for the house, so to speak. Again, this is not financial advice. This is just a thought experiment. So imagine it's time to come like make the down payment. An individual could borrow against their brokerage account, and people can borrow against like Bitcoin too. I'm just way less familiar with that, and that's of course like a more nascent, newer industry that's still like developing and evolving, and like more and more infrastructure is going to come out and surface on that. But just to think of especially because the question was about like borrowing against MSTR, so that brings us to the brokerage accounts. So theoretically, it comes time to make the down payment, one can borrow the amount of the down payment against their brokerage account, and then immediately at that point put on a huge like covered call trade, something as like because you now have like a margin loan, a margin like debt balance. So like one of the things I would want to do would be to like incrementally like reduce that margin loan through a couple different like creative levers that can be pulled. The first one I would do would be to put a large like covered call trade on the MSTR position in such a way where it's not like the 10 deltas for 30 to 40 days to expiration, like the Hermes Lux like perpetual philosophy. This would be like selling like 6 months till expiration at like the 1,000 strike MSTR for, like I said, 6 months, $1,000 strike with MSTR at like 390 or $400, where you look at a percentage of like one can look at a percentage of their MicroStrategy stack and be like, okay, I'm okay with 10 or 20% of my MSTR stack being called away at a price point that's more than double the current spot price. Allow me to say it again, at a strike price, like at a sale price that is more than double the current spot price. And if you have 6 months on that $1,000 strike call contract, there's going to be a sizable premium for that, right? Because of like the time value, and one can then decide like how deep or how close to the money that they would feel comfortable selling. But the point is, we're still at phase one of the down payment. One can borrow the down payment against their brokerage account. Next step, consider that 6 month 1,000 strikes, like the potential chance of selling 10 to 20% of one stack at a price that is more than double the current price. And then after that, this is where like the cash book comes in, right? Because there's that margin loan that exists. A decent chunk of that just got absolved by the covered call premium that just came in with the 6 month 1,000 strike. And then from there, what does a lot of the heavy lifting in an ongoing basis is the dividends from the cash book. It just eats into the margin loan and decreases that over time without new money coming in, being transferred in from the bank to help like bring the loan down. Of course, that's option number 3, or perhaps that's option number 4. Option number 3 would be to continue to do selling the covered calls and cash secured puts in the growth assets that one owns, or in the cash book assets, because then you really get the double whammy of cash secured puts. Although we should probably take the cash secured puts off the table here for this practical like down payment mortgage example, because cash secured puts, you could end up being assigned the shares where you're now taking like more money or more leverage even to buy those shares. So let's take the cash secured puts off the table, but you can continue to sell, or one can continue to sell covered calls against whatever growth assets they may have, and as well as the cash book assets, because then you get the double whammy effect of the covered call premiums plus the dividends. And these things are just eating into the size of the margin loan without new money coming in. And then step number 4 is like for new money to come in, whatever types of jobs or incomes or cash flow streams off to the side, like a percentage of that can just go into to reducing the size of the margin loan, which I do think is the crucial point here, right? Because there is an interest expense associated with borrowing money. It's like, wow, what a novel concept. There's an interest expense associated with borrowing money, but the brokerage accounts to start can be a little bit on the high side in terms of interest, such as like 10, 11, 12%. There's ways of talking to your rep to try and like negotiate that rate lower, but it might not be the most advantageous borrowing rates. So again, reducing the size of the margin loan is kind of the key point there. So yeah, that's just my like hypothetical thoughts on that. But again, the broader, bigger point is number 3, not number 4, which what I just said there. The broader point is like, this is something that has like tremendous like real life impacting risk. It should only be done by people who are confident enough to do this full time. And that's really the top line and the bottom line of that as far as that point's concerned. And then number 5 here, last question. Speculate on when money printing goes crazy and what signs will you flag as money burr being imminent. Look, I think there's a case to be made that like right now, like, the money printer's like going burr, right? I mean, what was it? The big beautiful bill was like $3 trillion in size. And we toss around the word trillion as if it's like we're almost like too normalized collectively to the scope and scale of the word trillion. But just to put this into context, in 2008 global financial crisis and the beginning part of 2009, well, really like most of 2009, in that like chaos and like early like reconstruction period of the economy, the government net spent about $1 trillion to rescue the American economy, hence the name, like the American like rescue package or policy, TARP. And like TARP and a couple of other components, you add all these things together, it's about $1 trillion net that it took to rescue and save America and the world from like a potential fiat collapse. Like, by the way, that was the big risk of 2008. It wasn't like Lehman Brothers going under. It wasn't like the banks failing. It was the fiat system collapsing entirely, right? It was the ATMs no longer like having money to come out, all of the bank's assets being frozen, all of credit markets drying up. Like, it's impossible to get a loan. It's impossible to like run a business. It's impossible to get a mortgage. Like, all of those things and worse were like legitimately on the table at that point in time. And I'm starting to ramble, or it's like what Donald Trump says. He goes, "I don't ramble, I weave." You gotta weave a couple ideas together to paint a big picture here. But so 2008 TARP reconstruction, it's about $1 trillion like net to save us from like a 100-year financial market storm, right? You then fast forward like, I don't know, 15, 16 years, a decade and a little bit more of time, which is 15, 16 years is like nothing in the grand scheme of history. But you go a decade and a little bit more out into the future, and a routine regular spending bill is $3 trillion. And 3x the amount that it took to save in a chaos doomsday scenario. The current spending amount is 3x that. And of course, it's hilarious that it's coming from like a Donald Trump type character who, like, pre-election, who will be like, like, we got to get the spending under control. He'll have like some chart and be like, Obama, you raise the debt too much. And there'll be like a chart that goes like this. But then that's pre-election Trump. But then post-election Trump is like proudly putting the word big as like the positive Trump seal of approval on like the big beautiful bill. It's just it's just so funny how you tie all these things together. But yeah, so with the combination of like the present day of having the big beautiful bill, as well as the other thing of let me see if I can try and pull this up real quick. The other thing of the increase in spending at Treasury. I posted about this recently. I just want to have the post here as a reference. Where'd it go? All right, forget it. It was that post about Treasury announcing that they're going to borrow like double for the quarter. Like they were expecting to spend like $500 billion for Q3 of this year, I believe it was, and they've already doubled that to $1 trillion. And I mean, that's just, again, back to the concept of just regular, ongoing course of business. We're obviously not in a crisis. In fact, things are like just swimming along, humming along. Most risk assets are at all-time highs, and or right near all-time highs. And a doubling of the borrowing, expense for a quarter from 500 billion to, $1 trillion is just standard business practice nowadays in Trump's 2025 here. So I guess there's an argument to be made that, like, right now we're in the money printer go burr type environment. Now, how does it get worse from here? Well, I'm very much with like Lynn Alden in regards to like nothing stops this train. I mean, the system of the American economy and the system of the broader global economy cannot function without rising asset prices. I mean, it's honestly like as simple as that, right? I mean, Ben Bernanke's talked about this in when he's talked about the wealth effect during like the early days of quantitative easing coming out of 2008 and the global financial crisis. He's like, look, and I'm no fan of Ben Bernanke, but I do think he's right about this in that like the wealth effect is real. If people see their stock portfolios are up and up and up as the months and years go on, they're going to spend more money. If people like check Zillow every once in a while on their own house and see like what the Zillow's estimate is for their house, and it's 50% higher than when it was 4 or 5 years ago, they're going to go spend more money. They might even take out a HELOC, a home equity line of credit, and spend even more money. So I do think that there's something to be said about the wealth effect as it pertains to the U.S. system of governments, like economies, like approaches that asset prices have to go higher, meaning the purchasing power of the dollar has to go lower. And I was on a phone call recently with BitStrategy, or one of our, pretty regular Google Meet calls. And he's just like ripping on a rant. And one of the things he says is, he's like, yeah, pull up the chart of the past 100 years with like the dollar's like purchasing power, and you'll see that it's lost 97% of its purchasing power over the past century. Good. That's what it's designed to do. Good. And the people who are aware of that phenomena benefited from it by, parking the majority of their capital, of their assets into true store of value assets for the past 100 years of their choice, right? Whether it was gold or real estate or S&P 500 equities. It's like, good. The dollar did go down 97%. And by the way, that's not even me. That's not even me saying it's like, oh, it's good. No, that's how the system is. I didn't create the system. Nobody created the system. We were born into the system as it is. That's why I keep coming back to this like objectivity over like ideology piece, is that like it doesn't matter what like I want or anyone wants or anyone ideology like they want to believe or like narrative they like choose to like tell themselves. What matters is like understanding the world as it is. The US system of government cannot function without having like rising asset prices. And by the way, the funny thing about that like 100-year chart of, the dollar losing 97% of its value is that the only time the purchasing power like of the dollar actually went up in like a noticeable like change of trend, it's like short-lived change of trend, but the only time those like blips up in purchasing power arise are during the Great Depression and during 2008, the global financial crisis, like the two biggest financial crises of the past like 150 years. I know there was something in the late 1800s, but I'm much less familiar than that. So yeah, in the past like 120, 130 years, the two biggest financial like crisis events was the Great Depression and 2008. And those are the only times on the chart in which the dollar's purchasing power is actually increasing instead of just perpetually decreasing like it does for most of the century. So yeah, as far as like there being like a sudden like shock of like M2 like ripping up, that would really require like an outlier event as far as I'm concerned. Like it would require something like COVID, like a dramatic exogenous external shock that the government, the powers that be feel that they have to respond to. Absent that event, I think we're just gonna, for the most part, generally speaking, there's gonna be larger bumps up and down along the way, but I think it's just gonna generally grind higher, right? Like for this whole American system of like the economy to keep working, asset prices have to keep going higher. Stability does not mean like flat. Stability means like a nice grind higher, a nice up and to the right trajectory. So that's what I think, the American economy needs to run on. So that's kind of what I bank on as being the status quo, unless there's like an event-driven reason for me not to be, such as something like the COVID shock and how like the early whisperings came out that like, no, this is going to be a bigger deal than like the president and like the administration is like letting on, or something like tariffs, right? Because something like the yen carry trade, I think that was like impossible to get ahead of, but something like tariffs, being a potential shock to that broader global, very interconnected, very globalized economy that I talked about earlier when I was dunking on Nvidia and Tesla, where there's just this global supply chain of raw materials moving back and forth, and then the finished products moving back and forth from country to country to country. And you throw a tariff like wrinkle into that mix, especially coming from a Donald Trump, art of the deal, like I'm down to like inflict some pain on this, like in the beginning to show how serious I am. Again, like art of the deal, like force your like competitors or fellow negotiators like to the negotiating table, and that ends up being accomplished by like sending a powerful signal. And by the way, there's no more powerful medium to send the signal through than through asset prices. Asset prices, the stock market, real estate, there is no better like perpetual scoreboard. It's the infinite game. Markets are the infinite game. These asset prices are just always with us. We can never turn them off. We can never stop them from existing. They're just always going to be there. And it's all very public, and it's all very relevant information that's constantly being discussed. In that like Last Survivor, or the story of the guy from 24 who like the Capitol building gets like blown up, and he's like the last guy to, succeed. So then he becomes the president. Like the day after he becomes the president, he asks his top advisor, he's like, what's the market looking like? And then his top advisor goes, all indices down sharply, sir. Like something like right to the point, down sharply. And the president in the show is like, so I guess this is not a good time to check my 401ks. Like it's just this fascinating perpetual scoreboard that everyone has a vested interest in, that everyone's always talking about. So that's why like asset prices are the best like public medium, like show of force power play that there is. So you consider all these things and it's like, yeah, this could be a potential like problematic period for the global economy, as it just throws a wrench into this again globalized, interconnected like global economy that all the major companies are forced to operate in all these major continents and things like that. So isn't that a long-winded answer to cover the money printer go burr and all the interdependencies and moving pieces involved there? Folks, I want to say thank you for listening. This has been a tremendous amount of fun. Again, I'm sorry I couldn't get this out earlier in terms of a couple months ago on the macro side, but even on the micro side, I intended to start filming this at 8 p.m. my time. I didn't start filming it until 10:45 my time. So in both the macro and the micro time sense, wish I could have got this out sooner, but I am very much looking forward to doing more of these, especially because the timing is right for me in the personal sense to be doing the show, and also I think in the broader, strategy trajectory, right? Because like a lot of this stuff is stuff that we talked about, me and Punter Jeff in the early Quant Bros episodes, of like what the FASB earnings impact could be, how that pertains to MicroStrategy potentially getting into the S&P 500, how that completes the reflexive flywheel of potentially having this perpetual bid on the MSTR stock, assuming that Bitcoin has a successful trajectory over the coming years. So it's just so incredibly fascinating that all of these things that we've been talking about, like I feel like my like life's work in a certain sense over the past couple years is really causing me to dance with destiny right now. And I think it's such an interesting, compelling time to be owning strategy, to be like deeply researching strategy. So that is why I'm super pumped to be doing more of these in the future. I'm super pumped to have a few guests on over the weeks. I think I'm going to try and get one show out per week. Don't hold me down to the day though. Sometime I'm going to try and aim for Mondays. I tried to do this yesterday, but my YouTube channel, which by the way, I made a new YouTube to stream this to, just like wasn't working. I needed 24 hours, but yeah, we're going to try and get this out on Monday. And by the way, I say we, it's me, my camera, and my microphone. That's the we. We're going to try and get we're going to try and do the live streams on Mondays. Maybe sometimes it's Tuesdays. We'll bring some guests on when it's fun and when it's appropriate. And yeah, I'm just super stoked to put out a fun research video project. And thank you all so much for joining, for hanging in there with me. I know it's pretty late out there for a lot of folks, but this has been awesome. This has been a really fun, even for me, first episode. So thank you all. Have a great night. Until next time. And be good out there, by the way. Be good.